Imagine running a business where, the absolute fastest way to generate just record-breaking profits is to intentionally turn away millions of dollars in sales.
Yeah, literally just walking away from piles of cash.
Right. It sounds crazy. But welcome to this deep dive. Today, we are looking at the Q2 2026 earnings call for Chubb Ltd. That's ticker symbol CB.
Huge player in the space.
Massive. And our mission today is to take this transcript, the strategic commentary from CEO Evan Greenberg and CFO Peter Enns, and really just cut through all the Wall Street jargon.
Right, getting to the actual numbers.
Exactly. We want to give you, the retail investor, an actionable take on whether this quarter was a hit or a miss. So we're going to hit the headline numbers, the real story driving those numbers, the management guidance, and finally our bottom line verdict.
And the central mystery we really have to solve today is how a company can actively shrink major portions of its revenue base, while at the exact same time posting just staggering profit margins.
Right, because it completely inverts the standard corporate playbook, doesn't it?
Oh, totally. I mean, we are so conditioned by the broader equity markets to just applaud relentless top-line revenue growth.
Yeah, just growth at all costs.
Exactly. Like if a standard tech or retail company announces they are deliberately abandoning a massive chunk of their market share, the stock plummets.
Oh, it tanks immediately.
Right. But in the world of elite insurance underwriting, top-line revenue is basically a vanity metric. What actually matters is the pricing of the risk you take on.
Okay, let's unpack this. I want to dive straight into the hard data, the sheer scale of the profitability they reported because, it sets the baseline for everything else we're going to talk about today.
Yeah, lay the numbers on us.
So for the second quarter of 2026, Chubb hit $2.8 billion in core operating earnings.
Billion with a B.
Billion with a B, which translates to $7.26 per share.
And, the growth rate on those figures is what really stands out to me initially.
Yep.
Yeah, because that $2.8 billion, that represents a 14.6% increase over the exact same quarter in the prior year. But notice the disparity when you look at the per share earnings. The earnings per share jumped by 18.2% year over year.
Wait, so overall earnings grew 14.6%, but per share grew 18.2%? That delta right there, that's the footprint of a massive share buyback program, isn't it?
Precisely. Yeah, they are aggressively repurchasing their own stock and retiring those shares.
Because when you shrink the total number of outstanding shares, every remaining share in the market suddenly holds a claim to a slightly larger slice of that $2.8 billion pie.
Exactly. It is a highly efficient mechanism for transferring value directly to you, the shareholder, assuming, of course, the stock is purchased at an attractive valuation.
Which management clearly believes it is.
No, without a doubt.
But, the real engine here is the underwriting. We have to look at how they actually generate that cash before they can even think about buying back stock.
Right. The actual business of insurance.
Right. So Chubb's property and casualty, the P&C underwriting income, it was over $1.9 billion for the quarter.
Which is huge.
It's up almost 19% from last year. And that brings us to the metric that really dictates everything in this industry, the combined ratio.
Yes. The holy grail metric.
Right. So they reported an 83.8% combined ratio on a current accident year basis. And if you actually back out the catastrophic weather events for the quarter, which cost them about $475 million, by the way, it drops to 82.2%.
We really need to dissect what that percentage actually means mechanically.
Yeah, let's do that.
Because an 83.8% combined ratio in today's macroeconomic environment is just a phenomenal achievement.
Right. And I want to conceptualize this for the listeners because combined ratio sounds incredibly opaque and frankly kind of boring.
It's pure Wall Street jargon.
Exactly. So for retail investors, think of the combined ratio like a golf score. Right?
Yeah.
Lower is always better. Or actually think of like a casino's payout rate.
Oh, I like the casino analogy, Bunner.
Right. So if a casino operates with an 83.8% combined ratio, it means that for every $100 gamblers put on the blackjack table, the casino pays out $83.80 in winnings to the players.
Plus the cost of, paying the dealers, keeping the lights on, the security cameras, all of that.
Exactly. All the expenses. So the casino keeps the remaining $16.20 as the house edge.
Pure profit.
Pure profit. Mm-hmm. In this scenario, Chubb is operating as the house. And 83.8% means for every dollar they take in as premium, they're spending about 84 cents on claims and expenses. They're keeping a 16.2% profit margin on every dollar of risk they price before they even invest the money.
The casino analogy is just perfect because it highlights the probabilistic nature of the business. I mean, the casino doesn't know which specific player is going to hit blackjack.
Right.
Just like Chubb doesn't know which specific warehouse is going to catch fire. But they have priced the collective risk so accurately that they are mathematically guaranteed to keep that 16.2% over a large enough sample size.
I have to challenge that 16.2% margin, though, just playing devil's advocate here.
Sure, go for it.
In a free market, if you are keeping 16 cents of pure profit on every single dollar, you are effectively painting a massive target on your back.
Oh, absolutely.
So why wouldn't a competitor, like a State Farm or an AIG or some venture-backed insurtech startup, just sweep into the market, offer the exact same policy with a 10% profit margin, undercut Chubb's pricing, and steal all of their clients overnight?
That is probably the most important question you can ask about an insurance company's moat.
Right, because it seems so easy to disrupt.
It does seem that way. But the reason a competitor cannot simply undercut them and steal the business is twofold. It's the complexity of risk, and it's the claims servicing capabilities.
Okay, break that down.
We are not talking about standard algorithmic auto insurance where you just plug in a zip code and a driver's age and spit out a premium.
Right, this isn't Geico.
Exactly. Chubb is insuring multinational supply chains, complex environmental liabilities, aviation fleets, cybersecurity networks for Fortune 500 companies.
Wow, okay.
You cannot algorithm your way into pricing a multi-billion-dollar offshore oil rig.
Yeah, I guess you can't just put that into a spreadsheet.
No. It requires deeply specialized engineering knowledge and decades of proprietary actuarial data that a new entrant simply does not possess.
So if a new entrant tries to undercut Chubb by pricing it at a 10% margin, they aren't actually pricing it. They're basically just guessing.
They're totally guessing. And in insurance, if you guess wrong on a catastrophic risk, you don't just lose your 10% margin, you bankrupt your entire company.
Wow. Okay, so the barrier to entry isn't capital, it's data and expertise.
Exactly. Furthermore, large corporate clients aren't just buying a piece of paper, they are buying the balance sheet and the legal defense capability of the insurer.
Meaning if things go sideways, they need someone with deep pockets.
Right. If a pharmaceutical company faces a massive class action lawsuit, they need an insurer with the specific legal infrastructure and the financial fortitude to fight that battle over a decade.
Right. A slightly cheaper premium from a newer, weaker competitor is utterly useless if that competitor goes insolvent halfway through the litigation.
Exactly. You get what you pay for.
And speaking of financial fortitude, we really have to look at the balance sheet that backs all of this up.
Yes, the investment side.
Their adjusted net investment income hit an absolute record of $1.88 billion for the quarter. That's up 11.7%.
Incredible numbers.
And their total invested assets now stand at a staggering $175 billion.
Yeah.
They grew their asset base by $14 billion in a single year.
That $175 billion figure transforms Chubb into a colossal financial fortress. I mean, it's just massive.
It really is.
And this brings us to a metric that CEO Evan Greenberg specifically highlighted on the call as the ultimate arbiter of shareholder wealth creation.
Which is?
Tangible book value per share.
Right. They reported that tangible book value per share is up 17.1% year over year.
Huge growth.
Let's break down the mechanics of tangible book value for a second, because it is distinctly different from the standard book value you might see on like a technology company's balance sheet.
Yeah. In the insurance industry, you have to look at statutory accounting versus standard GAAP accounting. But conceptually, tangible book value is the hard, liquid reality of the company's net worth.
The real money.
The real money. It strips out all the accounting fiction. It removes goodwill from past acquisitions. It removes intangible assets like brand value.
Right, because you can't pay a claim with brand value.
Exactly. It asks a very simple, brutal question. If we stopped writing new business tomorrow, paid off every single liability we owe, and liquidated the company, how much cold, hard cash and marketable securities would be left over to hand to the shareholders?
And growing that extremely conservative, purely liquid measure of wealth by 17.1% in 12 months is just incredible.
It's a masterclass.
I mean, they are generating an annualized core operating return on tangible equity of 21.2%.
Yeah.
They are taking their existing capital and compounding it at a rate well above 20%.
It is phenomenal capital allocation. But, all of these metrics, the $2.8 billion in earnings, the 83.8% combined ratio, the 17.1% growth in tangible book value.
Yeah.
These are backward-looking indicators.
Oh, right.
They tell us what happened. To understand if this is a durable long-term investment, we really need to transition into the underlying strategic story driving these numbers. We have to solve the paradox you introduced at the very beginning of this deep dive.
Right. The paradox of shrinking to win.
Exactly.
Because during the earnings call, management explicitly noted that they purposefully shed a significant volume of premium in U.S. large account and excess and surplus property lines.
They willingly walked away from top-line revenue.
Which is wild.
Yeah.
So to understand why they did this, we first have to define what excess and surplus, or E&S, actually is.
Right.
Because I think a lot of people might not know that term.
No, it's pretty niche. So the E&S market is essentially the safety valve of the insurance industry. When a standard insurance carrier looks at a risk and says, this is too weird, too dangerous, or too complex for our standard regulatory filings, that risk gets pushed into the E&S market.
So we are talking about highly specialized, non-standard risks, like an amusement park or a new type of chemical manufacturing plant or, a commercial building located right on a major fault line.
Yes, exactly. Those kinds of things. And because these risks are so volatile, E&S carriers have massive freedom.
Freedom to do what?
Well, they are not bound by the same strict state regulations regarding what they can charge or what specific language must be in the policies.
Oh, interesting.
Yeah, they have the flexibility to charge enormous premiums to compensate for the danger. Historically, E&S has been a highly profitable playground for sophisticated underwriters like Chubb.
But something broke in that market recently. Because Greenberg noted that the market pricing for the specific E&S property business that Chubb intentionally gave up was down around 40%.
Down 40%. Let that sink in.
I really need to stop and process that.
Yeah.
Because in an inflationary environment where the cost of building materials and labor to rebuild a destroyed property is skyrocketing.
Oh,
right?
yeah, through the roof.
The going rate to ensure those properties somehow plummeted by 40%. Why on earth would prices drop by nearly half when the underlying risk is getting wildly more expensive?
What's fascinating here is how it's entirely driven by the supply of naive capital.
Naive capital.
Yeah. Over the past few years, hedge funds, private equity firms, and just new market entrants saw the massive historical profits in the E&S space.
They saw the big margins and wanted in.
Exactly. They looked at the high interest rate environment and decided they wanted a piece of the action. So they flooded the market with fresh capital.
Okay, I see where this is going.
Right. When you have a massive influx of new insurance capacity, all chasing the same finite number of property risks, it triggers a price war. This is what the industry calls a soft market.
So you have these new entrants just slashing prices by 40% just to get their foot in the door and win the business.
Yeah.
And Chubb's response is simply, no thank you, we are going home.
Exactly. And it requires immense psychological discipline for an executive team to watch their competitors write millions of dollars in premium, grab market share, generate all this flashy top-line revenue, and simply refuse to participate.
It really does. Because analysts on Wall Street will be screaming at them asking why they aren't growing.
Exactly. But Chubb's actuaries ran the math. They know that if you slash premiums by 40% while the cost of materials and labor is rising, that business is mathematically guaranteed to generate a loss the moment a hurricane hits or a factory burns down.
It's guaranteed to lose money.
Guaranteed.
Man, it gets even more concerning when you look at the casualty side of the business, which involves liability lawsuits.
Oh, this is the really scary part.
Right. Greenberg made a pretty chilling observation about U.S. casualty loss costs. He noted that they are not benign.
Not at all.
Loss costs, which is the actual amount of money paid out to settle claims, they're rising at a steady 6% to 7% every single year for primary and casualty, and a massive 9.5% to 12% per year for excess casualty.
The excess casualty numbers are the most alarming by far.
Just quickly, what is excess casualty for those who might not know?
Excess casualty is the insurance policy that kicks in after the primary policy is completely exhausted.
Okay.
So if a trucking company gets into a horrific accident, their primary auto policy might cover the first, say, $5 million of liability.
Right.
The excess policy covers the next $50 million.
Got it. I have to ask about the underlying mechanism driving that 12% annual spike, though.
Yeah, it's wild.
Because we aren't seeing 12% more traffic accidents every year or 12% more slip and falls, right?
Wow.
The physical frequency of accidents hasn't drastically changed.
No, the real world is largely the same.
So what is actually happening out there to make the financial cost of these accidents compound at 12% a year?
It is a phenomenon the industry calls social inflation.
Social inflation.
Yeah. It has very little to do with standard economic inflation and basically everything to do with the U.S. legal system.
Oh, okay.
There are three main drivers here. First, you have a desensitization of juries. We live in a world where billions and trillions are thrown around in the news constantly.
Right. Everyone's a billionaire now.
Exactly. So a jury today looks at a severely injured plaintiff and a massive corporate defendant, and a $10 million verdict no longer feels like real money to them. They award $100 million.
Wow.
These are called nuclear verdicts.
Nuclear verdicts. $100 million verdict for a single accident. That completely obliterates the actuarial models that were built, 5 or 10 years ago?
It completely destroys them. The second driver is the rise of third-party litigation funding.
What's that?
You now have massive private equity funds whose entire business model is financing lawsuits.
Wait, really? Private equity is funding slip and falls.
Well, massive corporate liability lawsuits, yeah. They pay the plaintiff's legal fees in exchange for a percentage of the final settlement.
That's insane.
It means the plaintiff's attorneys have limitless war chests. They can afford to drag out litigation for years, hire the most expensive expert witnesses, and just refuse to settle for reasonable amounts.
Because they have the backing to just keep fighting.
Right. They are incentivized to roll the dice at a jury trial in hopes of hitting one of those nuclear verdicts.
And when the plaintiff is backed by a hedge fund, the insurance company can no longer just, starve them out in court. They are facing an equally well-capitalized opponent.
Exactly. The power dynamic completely shifts.
Wow. Okay, so what is the third driver?
The third driver is the erosion of tort reform and a shift in legal strategies, including something called reptile theory.
Reptile theory. That sounds like a sci-fi movie.
It does, but it's a real legal tactic. It's where attorneys specifically target the jury's primal fears of danger to provoke an emotional rather than logical financial award.
Oh, they appeal to the lizard brain.
Exactly, hence the name. So when you combine nuclear verdicts, litigation funding, and aggressive emotional tactics, the cost to settle a liability claim just skyrockets.
And that is your 12% annual increase in excess casualty costs.
Right there.
So let's put this all together into the underwriting equation.
Right.
Your loss costs the money flying out the door to pay these nuclear verdicts are rising by 12% a year.
Right.
Meanwhile, new competitors flooding the market are slashing the premiums you can charge to capture the business.
Yep.
So your revenue goes down, your costs go up, and your profit margin instantly evaporates into a massive bleeding loss.
Which brings us back to the naive capital, because Greenberg didn't just casually mention these new competitors. He actively called them out with incredibly pointed language on the call.
Oh yeah, he didn't hold back?
Not at all. He specifically targeted naive managing general agents, or MGAs, and certain elements of the London wholesale market.
Let's define an MGA, actually, because understanding their business model is totally crucial to understanding why the market gets so distorted in the first place.
Good point. So a managing general agent is essentially a specialized insurance broker that has been granted underwriting authority by a larger insurance carrier or a reinsurance company.
Okay, so the MGA acts like an insurance company. They evaluate the risk, set the premium, and issue the policy.
But here's the critical distinction. The MGA does not hold the ultimate financial risk on their own balance sheet.
Wait, they don't?
No, they do not. The risk belongs to the underlying carrier or the capital provider backing the MGA.
Oh.
And this creates a massive structural misalignment of incentives. MGAs are typically compensated based on the volume of premium they write. They take a percentage fee of the total sales.
I see. So if I run an MGA, my primary incentive is to write as many policies as humanly possible, as fast as possible, to generate maximum fee income for myself this quarter.
Exactly.
And if I drastically underprice a policy today just to win the sale against Chubb, I get my commission immediately.
Cash in hand.
But when that underpriced policy inevitably triggers a massive $50 million nuclear verdict 5 years from now, it isn't my money that gets wiped out. The capital provider who backed my paper takes the loss.
Exactly. It is the classic principal agent problem. The MGAs are pushing for volume at the expense of profitability because they don't bear the ultimate cost of the unprofitability.
That is wild.
It is. And Greenberg noted that he is observing brokers securing coverage terms from these naive markets that experienced underwriters discontinued 20 to 25 years ago.
You know, that specific time frame, 20 to 25 years ago, that is a staggering reference point for anyone who studies financial history.
Absolutely.
Because that takes us back to the late 1990s and early 2000s.
It does. And the early 2000s were an absolute bloodbath for the property and casualty insurance industry.
Just complete disaster.
It was an era defined by massive industry disruption, primarily driven by the fallout of asbestos liabilities.
Oh, right, the asbestos cases.
Yeah. Carriers had written policies decades earlier with incredibly loose, vague language regarding pollution and long-term health exposures. When the asbestos litigation wave finally hit, those poorly drafted contracts forced carriers to pay out billions of dollars they had never reserved for.
It bankrupted dozens of companies, didn't it?
Dozens. The industry only survived by drastically tightening policy language, introducing strict exclusions, and fundamentally changing how they drafted contracts to legally insulate themselves from endless liability.
And Greenberg is essentially standing on the earnings call, looking at the broader market today, and saying that today's new entrants lack institutional memory.
Exactly. He's saying the capital backing these aggressive MGAs wasn't around for the asbestos crisis. They're accepting loose terms and inadequate pricing today to chase yield, making the exact same fatal mistakes that nearly destroyed the entire industry a generation ago.
It is a phenomenal dynamic to observe. I mean, Chubb has the institutional memory to know exactly how this story ends. So they are perfectly content to shrink their top-line revenue in U.S. large account casualty and let the naive capital gorge themselves on underpriced, highly toxic risk.
Because the beautiful or terrible thing about insurance is the time delay.
Right.
The premium revenue comes in today, making the MGA look like a genius. But the losses from a complex liability claim might not materialize or get settled in court until, 2028 or 2029.
When those claims finally hit the courtrooms and the nuclear verdicts start rolling in, the naive players who underprice the risk will be absolutely decimated. Their balance sheets will be wiped out.
And Chubb, having maintained their discipline and protected their capital, will be standing there entirely unscathed.
Okay, so we have established that they are purposefully shrinking in toxic markets to protect their margins. But they are still growing their overall earnings.
Right, the 14.6% overall growth.
Right. So where is the growth actually coming from? I mean, if you are passing on the bad business, where do you find the good business in a competitive global market?
This is where their sheer scale and global diversification become their greatest weapons. They are not reliant on the U.S. commercial market.
Okay.
Let's look at their international retail business. This is a division that produces more than $17 billion in gross premiums annually, operating across 51 different countries.
Massive footprint.
Massive. And that entire international division grew by almost 12% in the quarter.
The regional breakdown of that international growth is actually pretty fascinating.
Yeah, hit me with the numbers.
So Latin America grew by 15.6%. Asia grew by 12%. Europe grew by nearly 7.5%. They are finding highly profitable growth opportunities overseas, where the legal environments are frankly far less litigious, and the market dynamics are much more favorable than the heavily contested U.S. space.
Yeah, you just don't have the same degree of social inflation or third-party litigation funding in Europe or Asia.
Right. The culture around suing people is totally different.
The tort systems operate entirely differently, so they can deploy their capital into those regions and achieve excellent risk-adjusted returns while they just wait out the stupidity in the U.S. market.
And it isn't just geographic diversification either. It is product diversification.
Oh, yeah.
Let's pivot to their high net worth personal lines division in North America. This is an absolute crown jewel of a business for them.
It really is.
It produces over $8 billion in gross premiums annually. And Chubb is the undisputed market leader in this specific niche.
Undisputed.
They grew this segment by 6% this quarter. But the metric that truly jumped off the page for me was their retention rate.
Yeah.
They have an account renewal retention rate of 90%.
Wow. A 90% retention rate in personal line insurance is almost unheard of.
Right, because the standard consumer insurance market is characterized by hyper-competition and extreme churn.
Totally. I mean, consumers are bombarded with television commercials promising to save them 15% on their auto insurance if they switch today.
Right. It is just a race to the bottom on price.
So how on earth does Chubb convince 9 out of 10 customers to renew their policies every single year without shopping around?
Well, it comes down to the fundamental value proposition, which was clarified perfectly during the Q&A session. Greenberg explicitly stated that Chubb is not competing in the general market auto or standard homeowner space.
They are not insuring standard stuff.
No, they are not trying to insure a standard suburban tract home or a 2018 Honda Civic. They are insuring highly complex, massive physical assets.
Right. If you own a $15 million historic estate perched on a cliff in a catastrophe-exposed coastal area of California or, a multi-million-dollar art collection, you do not care about saving $500 on your annual premium.
No, you are playing a completely different game.
Your primary concern is asset preservation and elite claim servicing.
Yes.
If a wildfire destroys that $15 million coastal estate, you don't want an insurance adjuster arguing with you over the depreciated value of your drywall.
Right. You don't want to be on hold at the call center for 3 hours.
Exactly. You want a company that has the specialized expertise and the network to source the exact type of 19th century Italian marble required to historically accurately rebuild your foyer. And you want them to do it with zero friction.
And because Chubb provides that highly technical, bespoke concierge-level claim service, they earn immense loyalty. The clients are prioritizing certainty and elite service over cheap pricing.
Which completely insulates Chubb from the price wars happening at the bottom of the consumer market.
It's a brilliant moat.
They can charge an actuarially sound premium, maintain their margins, and essentially keep the client for life.
And we really cannot discuss their growth engines without examining their life insurance division.
Oh, this is the sleeper hit of the quarter.
It really is. For a long time, the market viewed Chubb almost exclusively as a property and casualty behemoth.
Right.
The life division kind of flew under the radar, but it is rapidly becoming a massive structural driver of their earnings.
So the numbers here are startling. The life division produced $332 million of pre-tax income in the quarter, which is up 9%.
Which is solid.
But the scale is what shocked me. The life division now produces over $8 billion in annual premiums.
$8 billion.
Just 5 years ago, that number was $2.5 billion. They have more than tripled the size of this division in half a decade.
That is just a phenomenal story of both organic growth and highly strategic acquisitions. And the geographic focus of this growth is incredibly deliberate.
Where are they focusing?
The vast majority of their life exposure is in Asia. Specifically what they define as North Asia, which encompasses China, Hong Kong, Korea, and Taiwan.
Why the aggressive focus on North Asia for life insurance? What is the macroeconomic driver there?
It is a convergence of demographics and emerging middle-class wealth.
Okay.
You have rapidly aging populations in these countries who require long-term savings vehicles, retirement planning, and mortality protection. And simultaneously, you have a growing middle class with disposable income to actually purchase these financial products.
So Chubb has positioned itself to capture that generational wealth transfer and the demand for financial security in the fastest growing region on Earth.
Exactly. They also noted that their North America Chubb worksite benefits business was up 14%. So they are steadily building a powerhouse life and supplemental health business.
And structurally, this is brilliant because life insurance risks, mortality and morbidity are entirely uncorrelated to property and casualty risks.
Oh, that's a great point.
Right. If a massive hurricane hits Florida, it decimates the property division, but it has zero impact on the life insurance division in Taiwan.
It acts as a perfect macroeconomic counterbalance, just smoothing out the volatility of their overall earnings.
So we have established a clear narrative so far. Disciplined shrinking in toxic casualty markets, massive international expansion, a fortress high net worth business, and a booming uncorrelated life division.
Right.
But to truly validate the integrity of their balance sheet, we have to look into the dark art of the insurance industry.
The dark art.
Their reserves.
Ah, yes, reserving. Reserving is where the bodies are buried in insurance. It is the money a company sets aside today to pay claims that might not be fully resolved for years or even decades.
Exactly.
During the call, management noted that their paid-to-incurred ratio for the quarter ran at 90%. I want to spend some time breaking down the mechanics of this metric because it is the ultimate indicator of management's conservatism.
It really is.
What exactly does a 90% paid-to-incurred ratio actually signal?
Well, let's define the terms mechanically first. The paid portion is simple. That is the actual physical cash that flew out the door this quarter to settle claims and pay lawyers.
Okay, cash out the door.
The incurred portion is much more complex.
Right.
Incurred losses include the cash paid, but more importantly, they include the money the actuaries estimate they will eventually have to pay out in the future for accidents that happen this quarter.
This estimate is known as IBNR.
Right.
Incurred, but not reported.
Exactly, IBNR.
So IBNR is basically the actuary saying, look, we know thousands of car crashes and slip and falls happened this quarter. The lawsuits haven't even been filed yet, and we don't know the plaintiffs' names, but mathematically, based on history, we know the claims are coming. So we are going to take a massive chunk of our current revenue and lock it away in a vault today to pay for those future lawsuits.
Exactly. It is an accounting expense that reduces the reported profit today, even though the cash hasn't left the building yet.
Right.
Now, if the paid to incurred ratio is 90%, it means that for every $1 of total estimated losses they recognize on their income statement, they are only paying out 90 cents in actual cash.
Oh, I see. So they are hoarding cash. They are putting more money into the reserve vault than they are taking out to pay current claims.
Precisely. A ratio consistently running below 100% means they are actively building a massive buffer.
That's very conservative.
It is.
Yeah.
And management explicitly noted that this 90% ratio is running well below their historical pre-pandemic averages, which typically sat in the high 90s.
So they're being deliberately ultra-conservative right now.
Very much so. They grew their total net loss reserves to nearly $69 billion.
And I want to push back on why that $69 billion buffer is so utterly critical, because legacy issues always inevitably pop up in this business.
Oh, yours too.
And we saw a prime example of it in this very quarter. They disclosed that they took a $158 million hit of adverse development in their corporate runoff portfolio.
Wait, I need to stop you there. $158 million unexpected loss on old business sounds like a massive red flag.
It is a reality of long-tail liability. They specified that over 2/3 of that $158 million hit came from molestation-related claim development.
Oh, wow.
We're talking about horrific legacy liabilities, often involving institutions like schools, churches, or youth organizations where the actual abuse occurred decades ago.
But how does an event that happened in the 1980s suddenly hit the income statement of an insurance company in the year 2026?
It is driven by legislative changes.
Oh.
Many states across the U.S. have recently passed laws that either entirely eliminate or drastically extend the civil statute of limitations for filing historical abuse claims.
Right, allowing victims to finally seek justice.
Yes, exactly. They created look-back windows, allowing victims to sue for events that occurred 30 or 40 years ago. And when those lawsuits are filed today against the institution goes into his basement, finds the original Chubb insurance policy they bought in 1985, and demands coverage.
So Chubb suddenly has to defend and pay out a claim on a policy they haven't collected a premium on since the Reagan administration?
Exactly. And nobody wants to see adverse development. But the true test of a balance sheet is how it handles these shocks.
Right. Can it absorb the blow?
The fact that Chubb can absorb a highly unpredictable $158 million hit from decades-old legacy liabilities and still produce $2.8 billion in core operating earnings with an 83.8% combined ratio in the current quarter, it just proves that their balance sheet is practically bulletproof.
The ultra-conservative reserving in the current accident year, that 90% paid to incurred ratio we just talked about, it creates such a massive cushion that it easily absorbs and masks the unexpected sins of the distant past.
It is an incredible display of financial resilience.
It really is.
So we have looked deeply at the current numbers. We have unpacked the nuanced strategy of shrinking to win in casualty and growing in life and high net worth.
Yep.
Now, we really need to transition into the next major phase of our deep dive, management guidance.
Looking to the future.
Right. What are Evan Greenberg and Peter Enns telling us about where they are steering this $175 billion ship over the next few years?
Well, the most immediate and tangible form of forward-looking guidance management can provide isn't actually a revenue projection. It is how they allocate their capital today.
Oh, that makes sense. Actions speak louder than words.
Exactly. And their actions loudly broadcast a belief that their stock is undervalued. In the second quarter alone, Chubb returned $1.4 billion of capital directly to shareholders.
Let's break down the mechanics of that $1.4 billion. They paid out $395 million in traditional dividends, providing, a steady, reliable yield for income-focused investors.
Right.
But the heavyweight, aggressive move was executing $979 million in share repurchases. And crucially, they did this at an average price of $327.18 per share.
The price point is the key signal there. When an elite capital allocator like Evan Greenberg authorizes nearly $1 billion in buybacks at over $320 a share, he is explicitly telling the market that he believes the intrinsic value of the company is significantly higher than that.
Right. He wouldn't buy it if he thought it was overvalued.
Exactly. He views his own stock as the highest return investment available.
But they didn't just execute the current quarter's buybacks and call it a day. CFO Peter Enns announced that the board of directors just authorized a brand new, massive $7.5 billion share repurchase program.
That's huge.
This new authorization took effect on July 1st, and it has absolutely no expiration date.
$7.5 billion represents a massive percentage of their outstanding float.
Yeah.
Conceptually, this creates a structural floor under the start price. You have a guaranteed multi-billion-dollar buyer standing ready to step into the open market and gobble up shares whenever the price dips.
It provides incredible downside protection for the retail investor.
It really does.
But, a company can only authorize a $7.5 billion buyback program if they possess an absolute tidal wave of cash generation. Where's all this cash coming from?
Let's look at the macroeconomic investment tailwinds driving their portfolio, because this is where the math gets incredibly exciting for a long-term compounder.
All right, lay it out.
Their chief investment officer, Chris Hogan, detailed the dynamics of their fixed income portfolio during the call. And to understand this, we have to look at the mechanics of bond yields.
Okay.
Currently, their massive fixed income portfolio has a book yield of 5.1%. This represents the average interest rate of all the bonds they have accumulated over the past several years.
Right. But the magic happens at the margin, doesn't it?
Yes.
Because they reported that the new money they are generating today and the cash from old bonds that are maturing today is being reinvested into the market at an average rate of 5.5%.
Let's unpack the mechanism of this bond ladder, because it is an unstoppable mathematical escalator for their earnings.
Escalator, I like that.
Every single day, old bonds in their $173 billion fixed income portfolio mature. The bond issuer pays Chubb back the principal. Let's say those old bonds were purchased years ago during the zero interest rate environment, and they were only yielding like 3%.
Okay, so Chubb takes that principal, combines it with the massive new cash flow pouring in from their 16% underwriting profit margins, and they go out and buy newly issued bonds that are yielding 5.5%.
Yes.
They're systematically rolling their massive portfolio from low yields to high yields without taking any additional risk.
Precisely. And the sheer volume of cash moving onto that 5.5% escalator is just immense. Peter Enns highlighted that they generated approximately $16 billion in adjusted operating cash flow over the trailing 12 months.
$16 billion.
Imagine taking $16 billion in fresh, cold, hard cash and locking it in at a 5.5% essentially risk-free yield.
That's incredible.
The interest income alone on that new cash flow is nearly $900 million a year. It is a structural macroeconomic advantage that is compounding their wealth at an accelerating rate.
And they are amplifying this advantage by playing the debt leverage game brilliantly.
Oh yeah, they are very smart with debt.
During the quarter, they issued $2.2 billion in debt across a few different currencies, and they secured a weighted average cost of capital of just 4.2%.
It is incredibly smart, highly efficient balance sheet management. Think about the arbitrage here. If you can borrow $2.2 billion from the debt markets at 4.2% and immediately turn around and invest your operational cash flows into fixed income securities yielding 5.5%, you are capturing a 130 basis point risk-free spread.
You are literally printing money on the margin.
Exactly. And they are using some of these debt proceeds for general corporate purposes, including strategically refinancing older debt to optimize their maturity schedule.
Before we move off the financial housekeeping, they gave a quick note on taxes.
Oh, yeah.
Their effective tax rate for the quarter was 19.2%, which came in slightly below their previous guidance due to some discrete tax benefits related to equity awards vesting. But looking forward, they expect their core operating effective tax rate for the full year to settle back into the range of 19.5% to 20%.
It is a minor modeling detail, sure, but crucial if you are building out a discounted cash flow model for future earnings.
Right, absolutely. But the most revealing moment regarding their future earnings trajectory didn't actually come from a spreadsheet or a tax projection.
No, it came from a slightly tense, highly entertaining exchange during the Q&A portion of the earnings call.
Yes. The infamous Kremlin Watchers moment.
Oh, this was fantastic.
This exchange was incredible, and it tells you everything you need to know about the corporate culture at Chubb.
It really does.
For context, Evan Greenberg is a titan in the insurance industry. He has been doing this for decades. He is known for being incredibly direct, fiercely disciplined, and having absolutely zero tolerance for Wall Street analysts who get bogged down in short-term minutia.
The setup for the exchange was classic Wall Street. An analyst came on the line and essentially pressed Greenberg to bridge the gap between his highly confident strategic outlook and the fact that the company is facing obvious pricing competition and top-line revenue pressure in the casualty markets.
The analysts wanted a rigid formula.
Exactly. They wanted hyper-specific, short-term guidance on exactly what earnings per share growth would look like next quarter.
And Greenberg completely rejected the premise of the question. He pointed out that there had been all this nervous chatter and hand-wringing in the financial media over a single minor one-word change in Chubb's recent press release regarding their forward outlook.
Yeah, people were freaking out over one word.
Right. He explicitly called the analysts Kremlin Watchers.
It is a brilliant historical analogy. He was comparing the Wall Street analysts to Cold War intelligence spies who used to stand in Red Square, trying to divine the entire future of Soviet geopolitical policy based purely on which general was standing next to whom on a balcony in Moscow during a parade.
Right, looking for meaning in the tiniest little things.
He was mocking their obsession with microscopic details.
It was a sharp public rebuke of Wall Street's short-termism. He explicitly stated, "My outlook statement is not guidance, and it's looking out beyond the next few quarters to simply give a directional sense over a longer period."
He is flatly refusing to manage a $175 billion global enterprise quarter to quarter just to placate the Excel models of analysts.
Right. But here's the critical takeaway from that exchange. Despite refusing to give a rigid formula or a specific quarterly target, he was emphatically, aggressively bullish on their long-term compounding trajectory.
Very bullish.
He said, and this is a direct quote, "I am confident in our ability to produce very strong and potentially double-digit EPS growth."
Double-digit EPS growth for a company of this sheer size is a massive statement.
Massive.
And he grounded that confidence in the multiple levers they have built. He pointed to their global geographic mix, the strategic shift toward middle market and small commercial accounts, the dominance of their international consumer base, the explosive growth of the life business in Asia, and of course that $175 billion invested asset base churning out 5.5% yields.
He essentially looked at the analysts and said, "Look at our track record. We have produced double-digit EPS growth for many quarters, including an 18.2% jump this very quarter. We have multiple sources and handles to pull."
It was a masterclass in executive confidence and capital allocation theory. He even dropped another incredible line when discussing the costs associated with integrating artificial intelligence and new technology into their underwriting processes.
Oh, what did he say?
He told the analyst, "We measure it in hard dollars. This is not liberal arts around here."
This is not liberal arts around here. Man, that quote perfectly encapsulates the entire Chubb ethos, doesn't it?
It really does. It is ruthlessly quantitative, it is historically disciplined, and it is entirely focused on hard profitability rather than theoretical growth narratives.
Which brings us to the final act of our deep dive today. We have torn apart the headline numbers, we have unpacked the mechanical strategy of shrinking in casualty and growing in life, and we have analyzed their guidance and capital return programs.
Right.
So what is the bottom line actionable takeaway for the listener?
Based on the totality of the source material, the financial data, and the macro environment, the stance we have to take on this quarter is highly bullish.
Highly bullish.
Yes. If you are currently holding this stock, or if you are considering adding it to your portfolio, you are looking at an asset that management accurately describes as a consistent compounder of wealth.
And the primary why behind that bullish stance is their ironclad discipline. I mean, we operate in an equity market where executives are routinely seduced by the vanity metric of top-line revenue growth.
Right. They want to be the biggest, even if it means being unprofitable.
Exactly. But Chubb operates in the exact opposite manner. They're actively returning billions to shareholders through buybacks. They're locking in 5.5% yields on an accelerating wave of new cash. And They're absolutely refusing to write unprofitable E&S or casualty business just to make their growth charts look pretty for analysts.
They have built a fortress in a highly sloppy, undisciplined market. They have a $175 billion balance sheet, a combined ratio operating in the elite low 80s, and a 90% retention rate in their most profitable consumer segment.
They have constructed an all-weather financial vessel that can navigate the soft pricing markets of commercial casualty just as easily as it navigates catastrophic weather events and legacy litigation.
It's an incredibly strong position to be in.
So, we have established they are a fortress today, but I want to leave the listener with one final provocative thought to mull over, projecting a few years into the future.
Okay, let's hear it.
We talked extensively today about the naive competitors, the aggressive MGAs, the hedge fund-backed capacity, and the London wholesale market who are heavily underpricing U.S. casualty risks by up to 40% just to capture market share today.
Right, the ones chasing yield.
We know from the asbestos crisis 25 years ago that this behavior always inevitably ends in disaster for the undisciplined capital.
It does. It raises a fascinating strategic question about the next phase of the insurance cycle.
Exactly. When those underpriced policies inevitably mature and trigger a massive wave of nuclear verdicts and claims in, let's say, 2027 or 2028, it is going to wipe out the balance sheets of these weaker, naive players. They will face insolvency. What happens to the market then? That's the million-dollar question. Will Chubb's pristine balance sheet, their massive cash reserves, and their immense institutional patience allow them to play the ultimate role of the apex predator?
Oh, that's an interesting thought.
Right. When the naive capital is wiped out and forced into liquidation, will Chubb swoop into the wreckage and buy up the surviving assets, the infrastructure, or the high-quality client lists for absolute pennies on the dollar?
Are they shrinking to win today just to completely conquer the market tomorrow when the weak players fold?
Exactly. They are quietly setting the stage.
It is the ultimate advantage of possessing institutional memory. They remember exactly how the storms of 25 years ago destroyed their competitors, so they've built an impenetrable fortress today. They are waiting for the tide to go out because they know exactly who is swimming naked.
It's a dynamic you absolutely must watch closely over the next few years. And that is where we will leave it for this deep dive. Thank you for joining us, and we will see you next time as we continue to break down the complex realities behind the numbers.